Okay. Hello. Welcome back, everybody. Um, Sorry I'm not available to be in class over the next few weeks, but I suspect this is potentially somewhat helpful, given that you don't have to come to class necessarily during the evenings, but you know, feel free to do so. The classroom's still there for you. It's up to you. Um, Hopefully at this point I've already graded your exams and posted the scores. That is from the first exam that covered futures, forwards, and swaps and securitization. And I will have posted the solutions to the exam on Lamaku. I will work with my TA Mosin, who will help me proctor your second exam in a few weeks' time to redistribute your first exams to you, um, which will probably take place the night you take your second exam, largely because we're not necessarily meeting in person. If you do have specific questions going into the second part of the course, then feel free to reach out to me. I'll be largely on the East Coast, so I'll be 6 hours ahead of you. I'm happy to hop on a call, schedule some office hours with you. Um, okay, with that being said, housekeeping over, we're going to jump in and talk about the options segment of the course, and we're going to start here with option mechanics. And so what we're going to cover in this lecture, we're going to start off with discussing the different option types, the underlying securities that they're tied to, some basic contract specs, and the four basic payoff pictures, if you will, for the different positions you can take with exchange traded options in particular. Um, then we'll move on and talk about the intrinsic payoff and profit functions that is, adherent to these different four basic option positions. We'll talk about some basic terminology that market participants use, and then how we might have to adjust the prices of options depending upon what the underlying entity does, right? So if a company, for example, splits the number of shares, that's going to affect the options that are tied to them. And last in this lecture, we'll talk about the market structure, how the market makers work, how they get paid, and some other options that are option-like instruments that are available to purchase for market participants. All right, so first, kick it off with foundations here. Now, there's two types of options. The first type of option is something called a call option. And what a call option does, it gives you the right to buy the underlying security at a given price um, and buy before a certain maturity, or depending upon the kind, at maturity. The put option does the opposite. That is, it gives you the right to sell the underlying at a certain price. And that price, by the way, is called the strike price, right? The price at which you're allowed to sell it, or in the case of a call option, the price at which you're allowed to buy it. Um, for a put option, the value of the option increases as the underlying asset falls in price, right? So as a stock falls in price. The opposite is true for a call option. The value of the call option increases as the underlying price rises. So from sort of a market's perspective, right, a call option is a bullish bet on the underlying, and a put option is a bearish bet on the underlying. Now, among the calls and puts, there's two main types with regards to the contract specification. One is called the European style option. And this is one in which you can only exercise the option at expiration. That is, you have this single point, single decision point at the maturity of the option. This tends to be common for index options, for example, right? Options on the S&P 500, for example. Um, and an American style call option or put option. So an American style option is an option that can be exercised anytime before expiration. Um, And that means the value, if you will, of one of these assets, an American style option, is a continuous decision, and it can never be worth less than a similar option that happens to be a European style option, right? It would make sense, for example, right? You have more options, and so it has some value. So an American style option has more value, so it's worth at least as much as, if not greater than, a European style call or put option before expiration. And generally speaking, an American style call option or an American style put option is pretty standard for options written on equities. So what are the options typically written on? Well, I've already talked a fair bit about stock options. And so these can be single name stock options, like the options on the NVIDIA stock or DoorDash, for example. These are exchange traded options on, all of the major option exchanges, including the Chicago Board of Options Exchange, or otherwise known as the SIBO, the New York Stock Exchange, also known as NYSE ARCA, or even the Boston Stock Exchange, BOX. As I mentioned, these are American style and they're physically settled into shares, meaning if you exercise the option, you convert the contract that you paid for on the front end into the underlying shares, or vice versa. If that was a call option, for example. They're also written on ETFs, right, which are just baskets of stocks on the different markets. So these are the most actively traded. You can write them on you can buy them or sell them on foreign exchange, indices directly, and even futures. So we call these futures options. So there are plenty of different markets across which options exist. Um, so, plenty of ways to get your feet wet in the options market. So let's talk about some of the specifications of exchange traded options. What makes them tradable, first of all? Number one, they have a unified expiration date. They typically expire monthly on the third Fridays for what are called monthlies. There's also weeklies that expire weekly. There are something called zero date contracts that are daily. And then there's even something called leaps that extend out to as far as 3 years out. So, for example, you can have a bunch of different call options, for example, on the stock of Apple that might be a monthly, it could be a weekly, it could be zero date, it could be a leap across all different kinds of strike prices. And strike prices, are otherwise known as an exercise price, are also standardized on these exchanges. Typically for small dollar value stocks, it'll be in increments of maybe $1 or $2.50. And as the underlying stock price gets larger, the increments will space out, typically $5 or even $10 in the case of really high price stocks. I mentioned before the difference between American style and European style options. The exercise style is also, a standardized mechanism. And then, of course, the option class, either a call or a put. So these are the things that are defined in the contract that make them standardized. So a call or a put, American or European, the exercise price, and the maturity date. There are four basic option positions, which I alluded to. And here's the four main basic building blocks. First of all, the easiest one is that you can take a long position, which means you're just buying the option, and that is the long call position. So I'm going to buy a call. When I buy a call, unlike futures and forwards, I do pay a cost on the day I buy it. So we call this, purchase price, the call premium. And the call premium, right, gives me that right to buy the underlying asset or the underlying stock, for example, at a pre-specified price. Again, that pre-specified price is the strike price. And so if the stock increases in value and I can buy it at a pre-specified strike price, then my profit will be, essentially the difference between the two. And we'll talk more about that in a minute. The great benefit to taking a long position in a call option is that the only thing I could lose, that is my max loss ever, would be however much I paid for that option. Meaning, if the option expires sometime down the month, sometime down the road, the amount that I paid, I just lose that, right? Um, Another position I could take is a long put position. That is, I buy a put option. Again, I'm going to pay a premium, the put premium, and the value of this option will increase in value as the underlying share price falls below the strike price. Because remember, a put option gives me the right to sell something at a pre-specified strike price. Similar to a call option, if I buy a put option, then the most I could ever lose is however much I paid to enter that contract, right? Then, of course, there's the opposite side of each one of those trades. So a short call position is where I'm writing a call option. And why would I do that? Well, I would do that because I want to receive the call premium, right? So I get paid to write this call option. Unfortunately, my profit is capped at whatever the premium is that I earn for writing this call option. And the really challenging part of this endeavor is that my potential losses are unlimited, theoretically at least, right? Why? Well, because we know stock prices can go up indefinitely. And if I've written a call option, I'm exposed to the opposite side of that pricing action. Last but not least, I could write a put option. That is, it's a short put position. Again, why would I do it? In order to receive a premium, right? I receive the put premium, and again, my profit will be capped at the premium. And the most I could lose is if the underlying share price goes to zero, right? Because I wrote a put option, that means I'm on the hook for selling the underlying back to someone else who bought the put option at that pre-specified price. So at least relative to the short call position, my losses are not unlimited. They're bounded by the price of zero. So they're not as quote unquote risky as a call option, but you could definitely lose your shirt. Okay. All right, so let's talk about the different payoffs and profits of these four main basic diagrams here. First and foremost is a long call position. And what you'll notice here is that this is we have a couple standardized inputs for evaluating whether or not these are quote unquote profitable, or to get a sense for what the payoff function looks like. So here's our start. Typically, and I'm going to start, our typical setup for all of these problems on the front end, at least, is going to be talking about a European style option, just because they're easiest. We know that, time to maturity, T, we're going to have to hold it for that entire period. All right, so in this example, my call premium is $5 and my strike price is equal to $100. So we would typically map these such that the y-axis would be the profit or the payoff function, which I'll show you maybe on top of this one, is on the y-axis. And then on the x-axis here is the underlying stock price, right? S or S of T if you prefer. And let me see if I can draw on this with my iPad real quick. A moment here. Right. Theoretically, I should be able to draw on this. Right, so this is my profit function. What I want to do is show you what the payoff function looks like. So if I ignore sort of the cost of this option, it would mirror this profit function by shifting it up by the amount of the call premium. Said differently, if I ignored the cost, if you will, for buying this call option, my payoff would look like this red hook, which is to say that as share prices increase, right? That's what we're seeing here. As the share price gets bigger and bigger, the value of the option increases essentially dollar for dollar. This is what we call the intrinsic value of the option. And the reason it's shifted down for the, I would call this our payoff, right? The intrinsic payoff, if you will. Intrinsic. And then we shift it down by the amount of the call premium, minus $5 here. So that's what we're seeing here. And that's what your profit function is, right? It's your intrinsic value function shifted down by the profit function. A couple things you'll get from this is this picture alone will tell you that the break-even point must be the combination of the strike price and the call premium, right? And you can see that here because it crosses through at a point in which the share price is about $1.05 or $105, I mean, right? And the most, of course, that I could ever lose is the amounts by which I, paid for the call itself. Now, the upside to a call option, if I take a long call position, is, of course, that my upside is unlimited. So theoretically, the share price could be like, I don't know, Micron lately or SanDisk, I apologize, that's gone relatively infinite. All right. So that is a long call position. The sort of intuition between intrinsic payoff and the profit function, or the payoff of the profit function, will be very similar for all the different positions. Okay, so let me erase all that and move to the next slide to talk about a short call position. Sorry, short call position. And all we're doing there is flipping the exposure in terms of risk across the x-axis. So some of this should make sense. So from an intrinsic value perspective, right, we can build the actual intrinsic value line, and I guess my kink is not very kinked there, but basically, right, it has no value for share values below $100, but it starts to, in this case, lose money for me as the share price increases above $100. Why? Well, because the long side is gaining value, right? So that, of course, is my payoff function. And it's very symmetric around this x-axis in terms of the payoffs. So the max I could ever make, right, is the $5 from selling this thing. Hence why the exposure for the profit function is shifted up, right? This profit function. And then the max, the max I could ever make is $5. And I start losing money. That is, the break even is when the share price crosses through $105, right? As the share price increases here, or I should probably put it over here, right? So that's what we mean. So this is the short call position. The downside to this, of course, is that the losses are unlimited, just as the gains are unlimited for the long call position. The losses are unlimited as well for the short call position. Okay, the next payoff picture here is a long put. Here I'm going to make the same, pictures here. So here's our intrinsic value for the put option. And that is, it has no value for the region in which the share price, right, is greater than the strike price. In this example, our strike price is 70. So in this region, it's equal to 0, right, in terms of a payoff. But as the share price declines, right, as it crosses below $70, then we start making money dollar for dollar, right? And so again, for the long put position, this is my payoff, my intrinsic payoff, if you will. Well, that was a terrible writing, but here. And then, of course, this is my profit function. And it shifted down by the amount I paid for this option. That is, the profit function is shifted down by the $7 that I paid for the premium up here. $7. And I can determine my break even by just subtracting, if you will, the premium from the strike price, or in this case, $63. So as the share price goes below $63, then I start making positive profit, right, in this region. And the max gain I could ever make, though, is if the share price goes to zero, right? Zero, meaning at this point, which of course is also going to be $63. And clearly this scale is not drawn to scale. So my apologies, I'll fix that. All right. Last but not least, we'll take a look at a short put position, and just like a long put or a short call position, you're just flipping the payoff function, i.e., and the profit function around the x-axis. So we can draw the payoff function for a short put position as the following. Again, it's going to be worth 0 if the share price is above 70, right? In this region, it's equal to 0. And then for the once the share price starts falling below the strike price, that's when the position starts losing money, right? Losing money for us. The same intuition holds here because it's symmetric. Our max profit is the $7 that we receive from the put buyer. And then, of course, we start losing profits as the share price falls below $63 there. The max we could ever lose, of course, is if the share price hits 0 at this point. And again, it's not drawn to scale, but that's equal to $63. Okay. So just to summarize it, these are the 4 main payoff functions, right? So you'll notice I wrote payoff on these examples here as opposed to profit, hence why they're on the x-axis. And so we can use our intuition from before such that to identify this one would signify a situation where we start making money as the share price increases. So it must be the case that this is a long call position. If we flip the payoff function around the x-axis, which is what this diagram does down here, then that clearly must be the short call position. Over here, the share price starts making money. Sorry, the option starts making money as the share price declines, right? So this is consistent with a long put position. And then last but not least, of course, we have the short put over here. Okay. This slide essentially takes your payoff and profit functions, the pictures that we just drew, and puts them in with some notation here, okay? And that is your long call position is going to be the difference between one or the other. And so we're using a max function here. It's going to be equal to the max of the difference between the share price minus the strike price, or 0. So said differently, right? If the share price is below the strike price, well, then that would be a negative number, and it has there's no value there. So the value of it would be equal to 0. That is, the payoff would be equal to 0. Conversely, if the share price were greater than the strike price, then it would have some positive value. And the same intuition holds for short call position because you wrote the option, you're just putting the negative sign in front because you're on the hook for that relationship. For a long put position, this is one in which you have the ability to sell, right? The underlying security at the strike price K. And so it's going to be the difference between the strike price and the share price. So you can envision here, if the strike price is greater than the underlying share price, then this is going to be a positive number. It's going to have a positive payoff at expiration. Conversely, if the share price is above the strike price, well, you can see it's a negative sign. The max of something negative or zero is zero. So it has no value if the share price is above the strike price. For the short put option, we just put a minus sign in front, right? It just flips the exposure around the x-axis. So those are your payoffs. Those are the ones I was drawing, on the x-axis, if you will, for those zero value areas. And then the only difference between your payoff functions here, in terms of notation, is to include the call and put premiums from the perspective of the investor, right? So if you're a long call position, you take the payoff function, which is this, front part here, and then you just subtract the call premium. And we indicate typically a call premium as C. If you are the seller of the call position, well, then you earn it. Hence, there's a positive sign in front of it. The same logic holds for the put option, right? If you pay for a put, there's a negative sign in front. If you write the put, you earn the premium P, and so hence the positive sign. Okay, so what's great about at least the option payoffs and profits is that it's symmetric between the long position and the short positions. Okay, so let's jump in and talk about some terminology here. So you may hear of traders refer to option positions in terms of something called moneyness. Moneyness describes that intrinsic value picture, right? The payoff picture of the option position. And it's just, of course, the relationship between S and K. So if the option is in the money, it has a positive intrinsic value. What does that mean? Well, for a call option, it has positive intrinsic value if the share price is greater than the strike price, right? That's that bullish position from the perspective of the long position. So all these quote unquote moneyness relationships are from the perspective of the long buyer, right? The long call holder, the long put holder. So again, in the money call option, share price greater than strike price. For a put option, the opposite is true. That is, a put option is in the money if the share price is below the strike price. An option is at the money or ATM when the share price is equal to the strike price for both calls and puts. Hence, the intrinsic value is basically zero. And if the money is out, if the option is out of the money, OTM, it also has zero intrinsic value. And this is a situation in which the share price is less than the strike price for a call option, or for a put option, the share price is greater than the strike price, right? This is the region in which the max function is equal to zero, right? Because the difference, of course, would be less than zero, wouldn't make any sense, right? So here's a little example. We've got a stock whose price is $48 today. So that's our S0, if you will, our spot price of the stock. And we're looking at a call option with a strike price of $45. And so when you compare the strike price of $45 to the current stock price of $48, well, clearly the difference between them is positive for this call option. That is, it's in the money by $3, right? That is, the share price is greater than the strike price. For a put option, right? A put option with a strike price at $45 would be out of the money by $3. Again, the same reason we talked about before, right? The share price in this case, is less than greater than the strike price. And so it's out of the money by that same amount. And if we had a call option with a strike price at 50, we're moving the strike price while that share price remains at $48, well, then it would be out of the money by $2, right? So that's a sense for how to talk about the relative relationship between the strike and the share price with regards to giving a moneyness indicator on the option. Now, I want to talk a little bit about this idea of intrinsic value. What intrinsic value is one component of the options price. Another component of it is the value of that option being alive, which is to say the time value of that option. And both the intrinsic value payoff, right, and the time still living, the time that the option is still alive, both combine to give the option premium, that is the option price. And the idea for this is that, since the option is still alive, quote unquote, that it hasn't matured yet, it must be the case that there's some value for this, right? We call this the time value. And it's the premium that we're willing to pay for, in the case of someone who's buying the option, something positive to happen, right? For what could still happen, right? So said, differently, if we split these up, the intrinsic value is what it's worth now. And then the time value is, as I just mentioned, what could still happen. A couple things to take away from this is that the time value of the option is actually highest for when the share price is equal to the strike price. That is to say, when it's at the money. And then eventually that time value decays towards zero as the option approaches the maturity date. The time value is also driven by the volatility of the underlying shares. Okay. So just as a summary here, the maximum time value is occurring when the option is at the money. When it's deep in the money, the option's like way, way, way in the money. It's basically acting like the underlying stock. So the time value itself is small, meaning it's not going to move in terms of the option value won't change that much for any given change in the underlying share price. And then, deep out of the money options, basically it's all about time value, because of course, if it's deep out of the money, it has no intrinsic value, right? It's equal to zero for, puts and calls. So it has a low probability of paying off. So basically all the value is derived from the fact that it's not hit maturity yet. And we'll talk about something called delta in a few minutes here. Now, I think what might be helpful is if I draw you a picture of what this is really saying, because we have yet to look at a sort of actual cost curve for an option premium. So, it might make some sense to do that. So here's what I'm going to do. I'm going to go off script a little bit here. Let me pull up an option chain for you to look at. So we can go to Yahoo finance.yahoo.com. We can, take a look at any old stock. Let's go to NVIDIA. So we'll take a look at NVIDIA here. Okay. Okay, so here's the NVIDIA stock quote here. If you look down here on the left, we actually have option chains listed here. And so, for example, we know that the current share price of NVIDIA is about $223, okay, as of close of business today. And if you look down here, this one, the way it's listed is it has the the June 3rd expiration, which is tomorrow, from when I'm recording this lecture, um, which would have a quote unquote relatively small time value. And we'll take a look across all strike prices. And the color coding does here for us, it tells us the strike price relative to the underlying share price. So I'm going to scroll up here again. I said the share price is 223, right? And if I'm looking at call options, this column right here is the strike price, and here's all the maturity dates. Sorry, this is the June 3rd maturity, which means tomorrow. Well, because we're approaching maturity, there's not much time value left, right? So I can take a look here. And so these that are in the blue, for example, these are options who are in the money, right? ITM. Why? Well, because the current share price is about $223. And so anything with a strike price below 223 is in the money, hence they're in blue. And what we'll take a look at here is that we're going to look at the last price. This is the sort of price quote, if you will, for these options. So for the option that is um, priced at a strike price of 220, it has a value, if you will, of $380. That's on the ask price. So I'm just kind of looking at the bid and the ask here. And so that's what someone selling it to you would ask you to pay, essentially 380, which roughly makes sense if there's some other value. So said differently, the quote unquote intrinsic value would be the share price 228 point, sorry, that was wrong. 222, right? 0.82 minus the strike price of 220, right? So the intrinsic value is obviously $2.82, right? But I had mentioned that if you scroll down here, it has a cost to buy this thing of $3.80, right? So that $3.80 minus that intrinsic value is equivalent to the time value, meaning it's still alive. It has roughly a dollar's worth of value, right? 98 cents. You can look at the difference between these two, right? It's about 98 cents. So effectively, that 98 cents will disappear. If nothing else happens to the underlying share price, that 98 cents will disappear from value. Okay. And we'll talk about that later on. But that's the difference, between time value and intrinsic value. And so what you'll notice here, and I'm going to now switch screen sharing because I want to draw you a picture here. Let's see how do I do that. I need, I'm going to pull up a whiteboard here. Oh, I got to stop sharing. And then share the settings here. Sure about behavior advanced. I gotta figure out how to do this. Bear with me, my friends. Hold on. Post tools for sure. One participant, all participants. Yeah, I should be able to do it. Disabled by, all right. Post disabled participant whiteboarding. Okay. Well, that's weird. Try now. I gotta figure out how to fix that part. All right, let's go. Tell you what, I will pause the recording momentarily. If I could figure out how to do that. I'm trying to do too many things at one time, I guess. Okay, I figured it out. It took me a minute there. All right, so I'm going to draw um, the typical payoff function here. Let me just do this. Okay. So I'm just going to do it from the perspective of a call option here. All right. So here again on the x-axis here is the share price. And then this would be, in this case, this is our payoff function here. And then this will be our strike price. And so for a call option, it's going to have this intrinsic value that we've already seen before, right? This is the intrinsic payoff, if you will, from the perspective of, a long call position. Let's see if I can do that. No, do it again. Okay. Now, what you'll notice is that the actual call prices will never necessarily be this intrinsic payoff until maturity. So from that prior calculation we did before, notice how we were focusing on the area near the money or at the money, right? Because this is where the convexity of the payoff occurs. And so as this price of the call option approaches maturity, the time value starts to collapse towards the intrinsic value. And that's what we showed with that particular example. So this, even in the tails here, this distance, if you will, is a function of the time value of this option. All right, so jumping back to our lecture here. What about other mechanics that we got to think about? It's relatively, I think, straightforward, but in the case where there's dividends that are being paid, which is to say, well, we'll differentiate that in a minute here, or stock splits, we have to adjust the contract. So in the parlance of the, in the case where we have cash dividends here, then let me back up a little bit. If your underlying asset, this, and I'm just going to call it a stock, is paying a cash dividend, it's not going to affect the option contract typically, unless it's a really, really large dividend. And so it would trigger an adjustment, something like, something greater than 10% of the stock value, if you will, would be an extraordinary dividend, cash dividend. In the case where the company splits the stock, then you have to do an adjustment to the option contract because we don't want to change the economic value necessarily of the option because the economic value of the underlying stock has not changed at all, right? So just to say differently, if, for example, a company has a share price that has a value of $100 and they do what's called a 2-for-1, which is a typical one, N for M, a 2-for-1 stock split, they're basically just doubling the number of shares, which would mechanically cut the share price in half. Okay. So for the adjustment for an option contract, we're going to adjust the strike price K and the contract size. Okay. So what do I mean by that? Well, the strike price itself, right, is going to fall by half in this case. So M by N. So in my little example, if the strike price were, say, $100, right? So it's at the money. Then a 2-for-1, so M is equal to 1, N is equal to 2, it would just cut the share price in half to $50. And then the actual number of contracts themselves in my little, 2-for-1 example would be increased by that amount, right? So if you bought one contract, big N, and we did a 2-for-1, so 2 times 1 divided by 1 gives you 2, right? In the rare case that a company does a stock dividend instead of a cash dividend, then it's treated just like a stock split. although it'll be smaller. It'll be like, 5% or something like that. And so when you make that adjustment, it preserves the economic exercise, total exercise value, for example. It's preserved through the adjustment. So something to keep in mind. So here's an example. I'm not going to belabor the point too much, but you can kind of see here, this is a 2-for-1 stock split, which is typical. This is the example I was just saying was that, let's say the strike price was 40. And one thing I forgot to mention, and this is a very, very big uh, thing to have forgotten to mention, is that the contract value on all option contracts has a default value or multiplier, if you will, of 100 underlying shares, right? And so that's what you see here. The shares per contract is 100. And so I'll update the exchange slide a few slides earlier that really reflects that for us. So 100 shares per option contract. So keep that in mind. And I'll come back to this in a minute about how it affects the math, but basically we just add 2 zeros to everything. All right, so shares per contract, 100, strike price, $40. So in order to exercise, if you will, this contract, it would cost you $4,000, right? 100 times 40. And so, for example, if the share price were at $44 relative to the strike price of $40, well, then you'd be in the money at $4, right? This is in the money at $4, $4 per share, right? So that's in the money. $4 per share, you multiply it times the 100, that's where you end up with the intrinsic value of the total contract. Okay. Now, when we do a 2-for-1 stock split, now we're just increasing the multiplier, if you will. That is, the shares per contract gets doubled, and the strike price gets cut in half because it's a 2-for-1, but the economic impact isn't changed at all. So you're neither hurt nor helped by the split, just something to keep in mind. All right, so let's talk about how options trade and the other option-like instruments seemingly everywhere in the market. So unlike stocks and bonds, for example, remember the company themselves that the options are tied to is not figure out where my picture went here. Sorry. The options market is not populated, if you will, by providers, or I should say, is being issued by the corporations themselves. It's actually, issued by exchanges. So those exchanges need market makers to effectuate market trading and liquidity, right? So what do? Market makers are liquidity providers who have to quote both sides of the market, meaning a bid and an ask, and they have to do it continuously without knowing which way you're going to trade. This is their obligation to provide a two-sided market. How do they get paid? Well, the difference between the bid and the ask spread, and if there's a lot more competition by other market makers, say in the same stock options, then the spreads will be relatively narrow, which they typically are. They're, a few cents here and there, across most stocks, most large cap stocks, for example. These days, most of the market making is done entirely electronically, replacing all the auction-based open outcry options, pits, and stock exchanges and everything. So everything's gone digital as well. Okay. In terms of how we trade these options, now it turns out that you have to post margin if you're trading a naked option. And so what do I mean by that? Well, this is from the perspective of the option writer, right? So when you buy an option, the only thing you're on the hook for is just the um, is just the um, is the call premium. Okay, but when you write an option, you have to post margin, right? Because the exchange doesn't want to deal with you losing money, for example, and so they're going to require you to post margin. So how do they calculate it? Well, in the case of what's called a naked call, what is a naked call? A naked call is an option that is written where the option writer does not own the underlying security already. If that were the case, if you already held the underlying security, that would be called a covered, option, if you will, right? A covered option. Okay. Um, Now, how is the margin calculated? Well, it's the greater of two calculations. Number one, it's the 100% of the premium received, right? That's the actual call price, and an additional 20% of the underlying price, that is the stock price, minus the amount that it's out of the money. Okay. Or, right, 100% of the premium received plus 10% of the underlying. So basically, you have to calculate both of these prices or both of these calculations and then post margin equivalent to the greater of the two. In terms of a naked put, it looks relatively similar. The first calculation is exactly the same. 100% of the premium received plus 20% of the difference between the underlying price and the amount that it's out of the money. And in this case, for naked puts, calculation number two is 100% of the premium plus 10% of the strike price, not the underlying price, as in a naked call. Okay, so let's look at an example here. Here's a naked call that we're going to calculate. So in this case, the investor is writing one naked call where the share price is $50, the strike price is 55. The premium paid is $2 per underlying share, right? And back to my point that the multiplier is 100 shares per contract. Again, this is pretty standard for all exchange traded stock options and index options. It's typically on 100 underlying shares. Okay, so that's our setup here. And of course, given the difference between the strike price and the share price, it's a call option. So it's out of the money by, $5 here. So when we calculate the margin that we have to post under rule number one, again, it's the premium earned per contract, $2, plus 20% of the difference between the share price and the how much it's out of the money, right? And so what we end up with here, again, is the $2 premium plus the 20% times the share price minus the $5 that it's out of the money. Sorry, I think when I spoke earlier, the mathematics weren't as visible, hence why we have the brackets here to make sure we're doing our order of operations right. So in this case, it would be $7 per share or $700, right? That's rule number one. Now, rule number two was the premium plus 10% of the underlying share price. In this case, also happens to be $7, just coincidentally. The greater of these rules, neither one of which dominates. So $700 per contract is how much we have to post in our margin account. So something to keep in mind in terms of the actual mechanics, because we wrote the call in this case, we're receiving $2 per underlying or $200, which means we only have to post an additional $500 in terms of the call option premium here. Sorry, margin. All right, now I'll kind of wrap up this lecture and talk about different types of instruments that have option-like behavior. So there is a security called warrants, which are options that are typically bundled with bonds. Um, and these are instruments that are actually issued by a company, right? So they'll issue a bond, right? Whatever, $150 million bond, and they will attach warrants to it. And these are usually done to make the bonds look a bit more attractive, right? Meaning it could be a bond from a stressed company, right? And people are worried about getting paid. So they attach an option, if you will. And what that option does, it allows the bond buyer, or in this case, the warrant buyer, to exercise the warrants to create new shares. So basically, you buy the bond, you also get these warrants. These warrants are just options, right? And so when they exercise the warrant, of course, it actually issues new shares. That is, the company issues new shares based on the warrants contract provisions. And these warrants can be very long dated. You can see them out to even 15 years. And so this is a very historic common way for young companies or startup companies to get more money from the capital markets when they're trying to issue bonds, is to also issue warrants. We saw it, back in the early 2020s with a bunch of SPAC issuances, a lot of warrants, or we even saw it during the global financial crisis with financial institutions that were in a lot of trouble. And so they, issued a bunch of warrants to raise more capital to shore up the banks. And so many savvy traders, including Warren Buffett, who purchased a lot of, who recapitalized Goldman Sachs, for example, got a lot of warrants from that recapitalization, and thereby saving Goldman Sachs. Other options you may have heard of are employee stock options. We'll talk more about these later on. These are a form of compensation, as you might imagine, from the corporation to the employees, right? It's a form of remuneration, usually to executives, but to some employees, particularly startup companies. And they're usually struck at the money, meaning when they issue them, these employee stock options to their employees, the date that they issue them is the strike price, right? Whatever the share price is that day, that's the strike price. When employees do exercise these stock options, then it causes the company to issue new shares as well. So just like warrants, they are diluted to the existing shareholders. And since the early 2000s, there were a lot of accounting scandals back in the day in the late 90s, using employee stock options as a form of compensation, but not recognizing them on income statements and balance sheets. Well, primarily income statements. There were a fair bit of accounting standards rules changed. And so now they're expensed on the income statement at the fair value, meaning, we're recognizing these for what they are and their salary, right? Okay. Another type of option-like security is something called a convertible bond. So this is different than warrants because warrants are literally their own standalone security. They just happen to be issued sometimes with a bond, but not always. A convertible bond is a bond that actually converts into equity, right? It has an embedded equity call option. And it's again, these are issued by the company themselves. So the the bondholder in this case is basically holding a long call position. And really what typically happens is the bond acts like a straight bond, meaning it pays coupons over some time period. And then after some time period, the holder of that bond has the option to convert it into underlying shares of the company, so long as it's typically greater than some strike price embedded in the convertible bond contract. Right, so by some certain dates. So it's a combination, if you will, of the straight bond plus an equity call option. And in the case of convertible bonds, what's really interesting is that convertible bonds are often also callable bonds. So any callable bond, it could be a straight bond that's callable, but Most convertible bonds are also callable bonds, which means the issuer, the company, can redeem the call option back from the bondholder at some pre preordained face values of the bond, basically forcing the bondholder to convert it into cash, um, right? So they can call it back after some point in time. So convertible bonds quite quite interesting in many ways. Now, last but not least, there is a huge market in over-the-counter options here. And so the Chicago Board's option exchange and other, option exchanges are trying to create listed products that mimic some of these customized options out there. And I've listed them here. I'm not going to go into them necessarily, but you can see that there's always a struggle between exchange traded options that don't give the tailor-made exposure that the investor might want, and so they tend to go to the over-the-counter markets, which is to say, contact an investment bank who can then create one of these products for us, right? So flex options, binary options, credit binary events and or doom options, so deep out of the money puts. These are all different non-exchange traded type of options that exchanges are now trying to put on to the platforms to cater to those hedgers or speculators. All right, so some key takeaways from this lecture. We have our 4 positions: long and short call, long and short put. Basically, every option strategy ever decomposes into these 4 main positions. Takeaway number 2 is that the payoff function, and hence the profit function, has a very sharp kink, if you will, at the strike price. And we saw that they're basically hockey sticks, right? Takeaway number 3 is the value of an option, that is the price, is a combination of the intrinsic payoff and the time value before maturity of that option. And last but not least, options are everywhere. They're also embedded in other real securities. So we talked, I should say, we talked about warrants, employee stock options, convertible bonds, or even in mortgages, right? Like as a mortgage holder for a 30-year mortgage, if it's a fixed rate, I have the option to go refinance that mortgage. That is an option, right? That is what we call a real option. Anytime we're dealing with, real decisions, corporations also face real options all the time. And so if you take a look at this decision, for example, say you're running a simple, I don't know, a lemonade stand. Even your kids could be running this. Let's say you set up one lemonade stand. You have a real option to potentially set up another lemonade stand, for example, or to augment your current lemonade stand, or to abandon the lemonade stand altogether. All of these are what are called corporate real options, and they all have the same similar intuition, right? It's a long position or short position. It's a call or a put on some sort of operations, right? Generally from the perspective of a call position. But abandoning something, right, also has some value potentially if it's costly to run something. So there's a whole line of, corporate managerial decision making that involves these real options, which is highly related to the way we're going to be talking about and dealing with the pricing and the valuation of options going forward, so you can view them as one and the same. We're going to focus largely on exchange traded European style options when it comes to pricing these going forward. But again, you can use the intuition across the board. All right. And so when we come back next time, we are going to talk about the properties of stock options and the main levers or parameters that affect the value of an option. Okay. I will see you then.